Hello everyone, welcome to This Week in the Markets. Information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation, or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regard to your objectives, financial situation, and needs. Welcome to another round of market updates. Today we will cover movements in the benchmark index, trade data, gold, and the S&P 500 rally. The S&P 500 saw 20 points overnight as the Fed accidentally leaked its minutes to top Wall Street banks, law firms, and PE firms 19 hours before the scheduled release. The benchmark index closed at 1586 overnight after reaching a high of 1589. All 10 industries in the index rose, with technology and healthcare advancing approximately 2%. Trade balance shrank in February as overseas markets boosted exports and less oil was imported. The gap narrowed by 3.4% to 43 billion from a revised 44.5 billion in January, and below the forecast 44.8 billion. The US dollar index was relatively lower than current levels back in February, which is a big driver for boosting exports. Non-farm payrolls plunged 88,000 last month, making it the biggest miss since December 2009, and participation rate at a new 30-year low. The unemployment rate stands at 7.6%, largely due to a non-existent participation rate, which declined to 63.3%. Looking ahead, the Obama administration expects economic expansion upwards of 2.5% this year and above 3.3% next year. The US dollar index has fallen further from its 83.42 top following a shooting star candlestick last Thursday. Given that the index contains 57% euros, there is quite a strong co-integrated relationship with the euro dollar. A falling US dollar would strengthen the euro and vice versa. A falling dollar would also normally be bullish for commodities and bearish for treasuries. Pretty much, the dollar is king. The Aussie dollar is down approximately 40 pips in intraday trading after unemployment data in Down Under pointed towards a rise in the jobless rate, its highest level in more than 3 years. The rate currently stands at 5.6%. The number of full and part-time jobs declined by 7,400 and 28,700 respectively. The move should not come as a surprise, as the RBA did say that an increase in unemployment rate was expected at their last meeting. Unemployment has been rising since early 2012, and with the mining boom expected to peak this year, the RBA may be prompted to utilize its accommodative monetary policy and cut rates, which would bring down the AUD-USD, which is currently trading at 1.05, pretty much close to historical highs. In commodity markets, gold fell sharply overnight, trading currently at $15.60, while silver fell to $27.42 overnight. 1550 seems to be a strong support for gold, holding throughout late 2012 and 2011. Short-term resistance sits at 1584, and a close above this price would signal bullish momentum. Technically, the MACD is giving a convergence signal, forming higher lows while gold has fallen slightly. Traditionally, this is a very early and speculative buy signal. Taking a step back now from the S&P 500 rally, something just does not feel right. There are other markets that indicate that the S&P 500 rally may be running out of steam. Trends that would emerge in a traditional rally that aren't happening include small caps leading large cap stocks, consumer cyclical stocks leading consumer staple stocks, high volatility stocks leading low volatility stocks, growth stocks leading value stocks, and broad index leading high yield index. Now, none of these are prevalent in this current rally, and defensive stocks are leading this rally as opposed to aggressive stocks. Usually, a rally does not ride on the back of defensive stocks. This rally would be a lot more comfortable if small caps, growth stocks, high volatile stocks, and cyclical stocks were in charge. But they don't seem to be. Irrational exuberance, maybe. That's all for this week. On behalf of Trading Pursuits, we would like to wish you profitable trading.